We're going to address the Walt Disney production case. The first question is, why was Walt Disney production a takeover target? Disney has historically operated completely debt-free and an operating income from the theme parks. Breakup values of the business lines were above current trade values. Leadership lost the magic, and new leadership could perhaps revive that. Number two, the Disney major business segments: entertainment and recreation and real estate. They have great performance, differentiated, broad, and higher level of family entertainment found nowhere else. Little competition at that time. It's a cash cow. Consistently strong operating income, purchased with expansion of possibilities. Consumer products, average performance, low cost, broad cost leadership, has been profitable, and however, its operating income has been flat for the prior 4 years due to competitive companies creating new products based on new characters. Without new films or cartoons, they could not expand its products.
Yeah, the motion pictures service line had good performance, but was on the decline. They had demonstrated kind of cost leadership. They had a track record of innovation, including, starting colored animation, full-length animated films, and animated live action combined. Disney kept costs low using animated characters and actors who weren't megastars. And they also went and re-released previous films for revenue without additional costs and expanding to the next generation. As part of question 2, we were also asked to explain what criteria should be used to judge performance. Quite simply, we think it's just continued growth and sustaining strategic positioning. On question 3, we're asked to explain whether Disney is a growth company and what should define a growth company. We think Disney is a growth company since it can continue to innovate and expand value creation by focusing on Disney animation and other activities to build and reinforce the Disney brand. There are a lot of possibilities to expand on Disney's current activities and to work with other companies to pursue a sustained strategic vision. A growth company is also defined by the ability to generate significant positive cash flows or earnings that can be reinvested into new opportunities. Disney operated relatively free of debt, and due to the free cash from the theme parks, Disney was able to fund growth without taking on debt or accessing capital markets.
So the big question is how should Disney respond to Steinberg's offer? They really have 3 possible choices. They can do nothing and let him slowly take over the company. They can cash him out, or they can try to continue to dilute his shares and see how that works out. So far they've been attempting to dilute his shares, and that hasn't gone well. They've diminished a lot of Disney's value by doing this, and letting him slowly take over the company is not in anyone's best interest. They really don't want to break Disney up, and he really doesn't want to break Disney up. This is a power play. So Disney's best choice, and it leaves a dirty taste in the mouth, but their best choice is to pay him off. I don't think anyone's happy about it, but there's really nothing left to do.
And although it does take a lot of capital at the beginning to do the payoff, it will allow Disney to focus things again on what's made them successful, the vision that Walt Disney had. As far as the price that we believe would be a good place to start with this payoff, we think that Disney would be better off, first of all, keeping the Gibson deal, which would force Steinberg to pay the higher price of the 2 prices he gave. But then Disney pay back the Green Mail at a price of $75 per share. With that price and about 15.6 million shares being purchased by Steinberg, that would give him a profit of about $49 million, which is a little bit more than is what he earned from doing the same thing with Quaker Oats. If, on the other hand, Steinberg was successful at the takeover, as far as the financial consequences for him, he's already out about $250 million from his 10% that he already has purchased. The additional 37.1% would cost him about $1 billion more. A lot of that would lose value immediately once the stock returned to the market value. He would have small gains from the film library and from selling some real estate to some investors he already has lined up. Overall, his initial losses would be greater than his gains, and so accepting the green mail for a profit of around $50 million, it would be better for him. Public shareholders would also receive an immediate payoff, as he would be purchasing their shares at a premium. In aggregate, that's about 30 to 100 million, depending on the price that he pays. And so we believe that, like I said before, purchasing or paying the green mail will allow Disney to keep control of their company and really follow the vision that Walt Disney had, which has made them successful in the past. Thank you.